Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser, and I am joined by my producer, Matt. Matt, thank you for joining again. It's always so great to do a podcast with you. It makes it so easy for me.
We do have a good time too. Okay, so we were talking about a bunch of different things behind the scenes. Should we start with the Twitter files? Should we start with the market tumbling? What's on your mind lately?
Yeah, the Twitter files is a big topic. So let's just go and talk about the markets for a second. Obviously, we have the Fed raising again this week at the December FOMC meeting, the Federal Open Market Committee meeting, a half a basis, 50 basis points, 0.5%. And that kind of indicates that they say, okay, we start to see PPI, producer price index, and CPI come down 7.7 versus, in the 8s. So that is absolutely positive news. Although I wouldn't say that our CP number
it's like slightly milder bad news than we expected.
Yeah, I know. I remember at the beginning of this year when we were at in the 7s for the first time, everyone's like, what? And then now we're happy to see 7. So for sure, it's still not great news, but it is starting to see that, maybe the Fed is having a little bit of an impact. The concern I have, Matt, is that the true analysis shows that we really need to have a Fed funds rate. And I hate to even say this because the Fed is just announcing the 5.1% level that they're really trying to get to in 2023. But the analysis really shows that the Fed funds rate needs to be between 5 and 7%, which means we could have a lot more pain coming as we approach 5 and we still aren't seeing what we need. We will still see more pain. I'm sort of in the camp of all of this is going to terminate in some kind of massive economic black swan. So I don't think it's going to be this long slog. I do not predict that 2023 will be another 2022 where things are just slowly, painfully dying. It's sad and it's awful. And as a market commentator, a market analyst, and a market manager, it's very difficult to be like, okay, this is what is happening. And people just don't like going through long, slow, painful declines. It is painful as it is. We need a truncation. We need a cutoff of a system and a move to a new way. And that is what is coming. There's no stopping that coming. And that I think will be great. It will be painful and it will be awful for many, 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 many people. Most people, in fact, because most people don't listen to our podcast and aren't understanding that we are in a financially global transition period. This is and will be written in the history books. I have absolutely no doubt that we will read back in time to this time period and see a clear break of the existing system into a new system.
Interesting. Okay. Well, it's hard because part of me hopes you're right and part of me hopes you're wrong. Now it's, just going back and reading like Murray Rothbard's book about the Great Depression, you realize like what happens if we don't have that black swan economic event is we just get grinding year after year after year of this.
Like Japan, in their lost decade.
Yeah. How long? Yeah. I was going to say the lost decade. Yeah. So it can go on for a long time. I mean, the Depression essentially lasted from 29 into 46 before really we came out of that and the government scaled back and stopped trying to be, the be all end all of the economy. And we came out into another boom. So I don't think anybody wants to see that, but the government's doing all the things they did that extended the Great Depression, and nothing's going to stop that. There's no public opinion that's going to change that. There's no political action that's going to change it. We've just got to deal with it. So, I can see that happening
too. I think most people are afraid, right? They're just exactly where your sentiment is. You have a sense that something isn't normal and that something is afoot to change. And obviously that's supported by so much data that we relay on this podcast all the time. We're like, hey, let's show you this. Let's show you this. Let's show you this. So everyone is getting this sense. I mean, people that watch this podcast hopefully have a lot more knowledge, but most people in the world are getting this sense something doesn't feel normal and doesn't feel right. But then again, they're also very apprehensive to accept a big change and a big shift economically speaking, because we are in America. We have a very unique position as the world's reserve standard. So anything that threatens that or modifies that or changes that means that we're going to feel repercussions here in America. And so obviously everyone is a little bit scary of moving from the system that we're on into a new world.
Well, yes, and that's true. The interesting thing about it, there's a couple interesting things. for me, paying attention to the crypto space, that's really interesting because there's a potential. Now, I'm not saying it will go this way automatically, but there's the potential that there is an escape hatch from the inflation, from the manipulation at the government level and all this stuff. We've never had that before. Like in the entire history of the United States, we've never had an escape hatch from our own national currency unless you got into another other national currency, which was equally terribly run, partially because our own economists and politicians are out there strong-arming other countries into doing what we're doing so that all the currencies are rising at the same time. So they're trying to prevent us from having escape hatch, but now we have one. So I think that's an interesting thing to keep an eye on. There's obviously cryptos in the news recently for a lot of bad reasons, but that'll pass. And ultimately the technology, I think, will redeem itself. So I don't know. I think ultimately it would be a good thing in the history of the world for the U.S. to not have the power it has in terms of the reserve currency. And that sounds weird probably to a lot of conservative people that have been raised in, American exceptionalism and manifest destiny and all that stuff. But we're not acting like it. Like we're acting more like the Roman Empire in the 500s. And, we can either grind this out for another 1,000 years on the long, slow decline until we collapse. Or we can do something different. So it'll be interesting to see, because if we really do lose dollar reserve status, we're going to see a lot of things, and a lot of companies are going to suffer, and that's going to result in a lot of layoffs and things like that. I'm curious, what else do you think would happen? Because we do have an escape hatch. We do have other options. There are ways to exchange value like Bitcoin and things like that, where other countries around the world will trust it. So there is something else to move assets into. Does that change anything? Does that cushion the blow of something like that happening?
Wow. So much that you just said that I would love to dissect there. Just let me just take a few minutes and go through what you just said. So let's just talk very briefly about crypto, which I do believe is 100% an asset that can be decentralized finance and cannot be manipulated by, the central bankers, which is what really that's why they're going after it. That's why this whole FTX and Binance, we're talking on Friday morning, December the 16th. And if you look at Binance, they just literally lost their auditor. Literally as in the last 24 hours. So what that means is they had an auditor that had provided on the blockchain proof of their reserves, and that has now been taken down. So I said it before on the podcast, and I'll say it again for those of you that are in the crypto space. Understand that the government and central bankers of the world that are really harping on, oh my gosh, we need regulation, we need that regulation. It is complete bunk. Let's be clear, because the blockchain in and of itself is verifiable. So all you have to do is have a proof of reserves on the blockchain, and that alone proves the liquidity and solvency of the exchange. So there's no need for Washington or the Fed or the Bank of International Settlements or any central bank or any government entity to get involved. Of course, to the layperson who does not understand the blockchain and does not understand its veracity and its verification, which is in fact what gives it its merit and its worth. For those that don't understand that, they're going to be easily dissuaged from trusting it and believing in it and thinking that I need some big bad government to save me. And we can't have decentralized finance because look what happened to FTX and Binance. Binance has had 10 billion. That's not
decentralized finance.
It's exactly. And so they're pushing us obviously to central bank digital currencies. Yeah. Now that if we had nothing happen, and if we were to follow your kind of logic here that we don't have a black swan and we kind of just go through this long slogful process, and we will move to central bank digital currencies using fiat, nothing true, true hard assets backing it. And that is a disaster because we will learn nothing. But fortunately for us, Matt, there is an end. There is an exact answer to 2 + 2 = 4. And math is absolute, and that is the reason that I am drawn to it as an absolute science. It is a science that cannot be manipulated, just like the blockchain without a T-fork. So what I would say is that we are at the end of the existing system. It's not a speculative thing at this point. We are at the end. And just to put it into three very understandable points for the person who's just joining the podcast for the first time, we are now insolvent at the Federal Reserve. And I'll explain to you what I mean by that. So that's number one, the Fed is insolvent, and we will come back to that. Number two, we have the petrodollar has ended. It ended when we kicked Russia out of the SWIFT system, because Russia and OPEC has traded as a block always together in the US dollar. And Russia getting kicked out of SWIFT and switching natural gas and crude to be traded or bought only in rubles and gold basically ended the petrodollar. We still have OPEC, but that's what remains and is now ending. So we had a clear military alignment after the United States exited Afghanistan in April of 2021. Russia and Saudi Arabia entered into a security agreement similar to the security agreement we gave them in February of 1974 to create the petrodollar. So Russia is now Saudi Arabia's military backup. Tell that to the United States. The other thing is the Saudi Arabia came out in November and very clearly, without using specific announcements that are official yet, very clearly stated in unequivocal terms, China is their number one economic trading partner. They view China first as their economic partner. China has just come out in the last 10 days and announced that they are working with Saudi Arabia to start buying crude in Chinese yuan. The second that Saudi Arabia releases itself and its 13 OPEC nations to begin to sell crude outside of US dollar, petrodollar is broken, and you will see a dollar collapse. It is inevitable. It is inevitable. So we have the BRICS nations as the third part of these three-part thing that I'm telling you. We have the BRICS nations that, pulled, and if you watch this podcast, our users know we had 388 tons, the largest institutional pull out of the West vaults, COMEX, LBMA, of actual metals transferred to the East. It's the largest transfer since 1967. And I will remind our users, our listeners, that in 1967, we were still on the gold standard. We didn't come off of the gold standard until April 15th, 1971, completely. So if we go back to the first point about the Federal Reserve, our leverage right now at the Federal Reserve is almost 200 to 1. To give you a perspective of that, in 2008, 2009, we were about 40 to 1. We had about $40 of asset treasuries, meaning mortgage-backed securities and treasury, actual treasuries, to every real dollar of cash that the Fed held. That was in 2008, 2009. Now, and you can understand that was at the period of the global financial crisis, or we call it in America the Great Recession. If you look at the Fed's balance sheet today, December 2022, you'll see that we're about 8.6 trillion in total treasuries and mortgage-backed securities. Mortgage-backed securities are about 2.6 trillion of that, which means these are the longer term bonds that are extremely low, because most of this paper was issued in 2020 or earlier. So we're talking about Fed funds rate of 25 basis points around that time. So that 8.6 trillion is generating very low interest income on a monthly basis that we're holding. But now they've raised the overnight Fed funds rate that they have to pay on deposits to over 4%. So the Fed is paying 4+%, 4.25 to 4.5 on overnight deposits, but they're not even making 1% on their average on the 8.6. We are in negative cash flow with the Federal Reserve as we speak. Now, what has that impacted to the U.S. budget? We have entered, we just had $103 billion deficit in the last 2 months because there's no $60 billion of interest income coming from the Fed now. It's not coming. So now we're in a sense of urgency that is not going to allow us to do a 10-year slog like Japan, because we are, Matt, at this point where, the best analogy I can give you is the movie Titanic. I use this movie for so many analogies, but there is a scene in the movie where it goes down to the propeller underground in the water, and it's going, and then you just finally see it, and it just stops. And that's where we are. I can't tell you it's imminent this month, next month, but I am telling you, we will not go through much further amount of time. I certainly don't see all of 2023. I think we are eminently onto a black swan here.
There's a lot to unpack there, but I get it. This is similar to like it's interesting because the human body works very much the same way. You put it under stress, and you think, I'm okay, I'm all right, I'm just alive. Yeah, little symptoms here and there, bam, you get a diagnosis of something, and then you realize, crap, like something major broke, right? So I think that's the analogy. So you don't think we'll get through 2023? Do you have any sense of what the market is that's going to pop? In the sense, like, we had the .com, we had the real estate. Do you have any sense of where, like, what industry is at the most risk?
Well, certainly, we've already had, and this is really sad that the world doesn't admit this. I mean, Americans are under such obfuscation of our media. And that is something that will be coming out in the next several months. You will see, and it's starting with the Twitter files, that is the beginning, but obviously Twitter is just one medium. There's so much obfuscation. There's so much data that I get from my global sense that is not promulgated here in the United States. It's just not put out. Americans are kept in the dark. We don't know. And I'm sick of it. I mean, wake up. America needs to wake up and read the tea leaves globally. So the collapse of the bond market, everyone talks about equities, the Dow's done this, the S&P's done this. And of course we love equities and we're big market lovers, not this kind of market, but the real institutional money that runs the world is bonds. And we just had in the last 3 months, the global yield curve for bonds invert. That hasn't happened since 2000. So there is all kinds of risk with bonds. But if we look at other countries right now, the hatred of the US dollar on the part of most other countries in the world, which is why you're starting to see this massive, almost like a magnetism of the BRICS alternative reserve that is forthcoming. Because what's happening is the IMF, the International Monetary Fund, has a really standard operating model. They go into a country and say, we're going to give you these loans that will help you industrialize your energy, industrialize your water supply, industrialize your transportation. They help countries become industrialized through IMF loans. Now and of course that's supposed to bring more industry to the nation, which will then bring more revenue, which then they can then pay those loans back. It's all this, this development sort of, series of actions. But the problem with the IMF loans with these countries is these IMF loans are denominated in US dollars, while their assets, of course, and their earnings are in their local domestic currencies. So as the dollar has remained very strong this year, while the rest of the world's bonds are collapsing, it's made their debt that much more expensive. So you're looking at countries that want to dump the dollar because it is too expensive. Japan is one of the biggest, just to maintain the price of their yen against the strong US dollar, they're having to do a lot of things. So we could look at Japan dumping their treasuries. They're the second largest holder of treasuries in the world. That alone could have a massive impact on the dollar. And at some point we have to expect that this will happen, Matt. But I think that you're right. And in terms of the economic ramifications, I think that those might, and they could probably be stretched out for another 6 months. But what is going to happen in my prognostication is that you're going to see a lot of geopolitical events that will spur a black swan before we ever get to the true organic black swan in and of itself. In other words, the house of cards with the dollar is so fickle right now. It's an illusion. It's a facade. It is absolutely a facade. The US dollar, its strength versus other currencies is only because Powell has been raising and been hawkish because he knows that unlike Yellen, we put way too much money too fast into the economy after coronavirus. It caused all of this, excessive inflation. And so in order to look like the dollar is strong and not inflating and weakening, he has been very, very, very hawkish. And so that has given the illusion that the dollar is still very strongly footed. But the truth is, with the status of the Federal Reserve balance sheet, the status of negative cash flow, that the reality will overcome the facade very soon enough. But if anything globally kicks off, which it will, there is a lot coming. Just information disclosure alone, declassification information that will be coming out to the world. It is on its way. It begins with the Twitter files, which is very mild, but what comes after that is much bigger. And I am submitting that the geopolitical changes will just overpower the facade of the strong dollar and the economic currency that we currently are living in.
All right. Yeah, that makes sense. And I would assume it would start with, countries where U.S. influence is weakening. I mean, that's essentially what happened with the Roman Empire. It started to fray at the fringes and Rome had to pull back. Yeah. And it went, from the areas where it was too costly to project its power, yep. It had to start pulling back and just acknowledging that, hey, we just don't have the power to control what they're doing anymore. And then, just kind of like it ends up shrinking to the point where, yeah, that was what was interesting about the collapse of the Roman Empire, is it really was taken over from within and corroded from within long before the barbarians actually stormed the gates, so to speak. And what's funny about it is that once they stormed the gates, they just kind of took over the existing structure and kept right on going and just kind of used what was there. So yeah, I could see something like that, something similar happening where the countries around the world that we don't have, we've been trying to project control there, but we don't actually have strong control, and we're really no military threat to them from all the way over here for whatever reason, or they have countries nearby like China that are they need to be in their orbit, and they need to be on better relations with China than they need to be on good relations with us. So they're going to shift their allegiance, right? Yeah. So I can see that. I can see that happening. And you think the geopolitical stuff is going to be the first signs of that?
Well, yeah, I mean, I think that, there's so much going on geopolitically. Any one thing that could happen would just sever the illusion of financial and economic security, right? We're just at the end of the debt fiat system. This has probably been over 100 years in the making, certainly since 1913 when the Federal Reserve was chartered. So people are like, gosh, this will happen so fast. No, this has been a long, slow process. I think since we've come off the gold as the reserve in 1971. I mean, we're talking about 51 years. So this is not like it happened overnight. But when you have central banks that really have the ability, and this is exactly what really upsets me more than anything, is that we have these central bankers that are talking about pushing to CBDCs when their existing system is failing. So, we don't want to give the failures a complete and total totalitarianistic control over all of the money supply of the whole earth, because that we can see how that will go horribly wrong. Anything that could happen, Matt, China invading Taiwan, which is a possibility, right? Russia and NATO escalating a subterfuge of the Ukraine and NATO Russia fight, which is really NATO versus Russia, has been since the jump. Every NATO country's been sending Ukraine weapons that have basically allowed it to fight a proxy war. Give me a break. We know what's happening. So if that escalates and becomes like Russia, NATO, I mean, then you've got a nuclear threat, we've got North Korea setting off tests. I mean, we've got so many theaters of explosive possibilities that you don't need just a tiny little spark, not even a match, a spark could light a match, could implode the whole thing. So this is the most economically feeble the world has been probably in at least 70 years.
Okay, well, then let's finish with this. So what is the average entrepreneur, business owner, high income professional? All of our incomes, all of my clients are paying in dollars. I have one income stream there's a percentage of revenue. So if inflation runs away, my income runs away with it. It keeps pace with it, so that's fine. But what does the average person do? Do we need to go out and invest in gold? Do we need to look at other things? What's your advice there?
I would say this is not the time to go it alone. This is definitely the time to go to a professional. I think that, not to my industry's discredit, but I think that professional advice has really not been valued in the last probably, I would say, at least maybe even since the .com crash, 2002. So we're talking about a good 20 years. And of course that makes sense because outside of the .com crash and the lost decade that we had in America, you could really just throw a dart at the S&P sort of, what do you call those things? You throw darts at.
Oh, dartboard.
I forget the name of it. Dartboard. Yeah. You could throw a dart at any S&P and you'd get any sector that would have performed well for you, and you didn't necessarily need professional management.
Right.
So a lot of people we've seen so many people this year coming to us for the first time that have been managing their own portfolios for at least 10 or 15 years. And so I would say to people, this is not the time to go it alone. I would also say to people, this is also not the time to probably hire just a regular traditional advisor that does not understand the scope of the global world. Because a lot of advisors, not that this is bad, this is just the way most of Wall Street is. They're what I would call really microeconomically focused. They're looking at quarterly swings and revenues and meets and surprises and beats and misses. And that's kind of their realm of world of just what does a corporation's cash flow looks like, and is it going to be a good buy for us? Is it the 200 or 50-day moving average moving? I mean, they're technical, they're fundamental analysis, and that's just kind of the world they exist in. It's very, very siloed. And we are going through a global economic transition. It is happening. Whether you believe that the central bankers will have their way and move us onto central bank digital currency, that's still a transition of massive proportion, or whether you believe, as I believe, that we have been outsmarted, outmoded, and outstrategized by the BRICS nations, and now America will have no choice but to ourselves go back to hard asset currency, which is what I fully believe. And if you just think through the logic of it, you'll see that there's no other alternative that will make viable economic sense. And I'll just explain that in 2 seconds by saying that if we do not move to a hard asset backed currency, with China moving to hard asset backed currencies through the BRICS union and their new reserve, how is our largest supplier nation going to continue to accept fiat currency from America when the whole rest of their trading bloc is dealing with hard asset-backed currency? And you can also see that if America does decide to go to hard asset-backed currency, because we will have no choice, that will also change who America is. Because if you start off with America's gold reserves and China's gold reserves, we run massive trade deficits to China on an annual basis. So if we're transferring currency that's gold backed, and we do this over a subsequent period of time, we will be transferring them the whole of our assets, and we will have nothing because we're consuming consumables that don't remain and don't last. Right. So that also will force America to redomesticate supply chains again. I'm not suggesting that we'll go back to our heyday and our, manufacturing heyday.
No, because the government won't allow that.
Right. But I am suggesting that we will not be able to continue to just be the service. You provide everything for us, and we just will worry about services, and we're a consumer nation. And you can just that model will end as the world moves to hard asset-backed currencies again. So my supposition is that we have reached the end of fiat. It is upon us. It is going to be very painful for most people because I think the biggest thing is people are going to be shocked. They have no idea what's coming. If you call up a traditional Wall Street microeconomic person, they're just thinking in terms of the next 4 quarters. They're not understanding, wow, the whole Earth's economy and our fundamental currencies are shifting. We are moving from just dollar hegemony and the United States being the single and premier global reserve to multipolarity, which is the BRICS group, and I would say the West, which would be Europe and Australia, New Zealand, Canada, and America. So we are moving to multipolarity. And because of that, and because they are moving to asset-backed again, they are forcing America's hand, whether we want to admit it or not, which is why the World Economic Forum and the United Nations signed a memorandum of understanding, an MOU, in March of this year to basically speed up the time frame of Agenda 2030 from 2030 to 2023. This is why we're already in a 12-week pilot with MasterCard and several commercial banks in the United States for the digital dollar called FedNow. And that is why if you go to the FedNow government website, you'll see that it says that it is live to go in May to July of next year. This is why they have moved their time frame up so much, because they realize that we are at the end of debt fiat as well.
Interesting. All right. So the answer, first of all, is get in touch with macroeconomic economics and just, pay attention to what's going on at a macro level, not just at the stuff that you hear on CNN and Fox in terms of what's going on day to day in the market, because the market is a terrible indicator, unfortunately, of what's going on, like a
lagging indicator too.
Yeah.
Right.
All right. So then how do people get in touch with you and your staff?
We are, this is obviously the podcast I do for fun and just to speak about my opinion and kind of give people a much broader perspective than just these little national interviews that I do all the time. So my practice is Walser Wealth. So you can go to walserwealth.com and get in touch with our team and those that follow, this much bigger piece of the world and how to position right now for what is coming. Which is difficult, right? It's hard, Matt. Yeah. It's hard to give any kind of security when the whole world is changing. But we, at least with our client base, we've been telling them, we actually were on the forefront in November of last year. I let the whole practice know I saw 2022 as a mean reversion year, meaning I knew that this is before Russia invaded Ukraine. So this is before all of the macro stuff started to go crazy. I saw mean reversion. I saw the markets coming down substantially. And then, of course, everything changed once February happened, Russia and Ukraine. But we were able to let our clients know, hey, that the one piece, I'm usually contrarian to what everyone else is saying because everyone's not singing from the same song book all the time. And usually it's wrong. It leads you to the wrong place. So I'm usually contrarian, but the one piece of conventional advice I absolutely adhere to religiously is buy low, sell high, buy low, sell high, and so we let our client base know that we saw that this year would be a reversion year. And so if you wanted to get out at the top, because a lot of, what I have learned this year is that clients don't do a very good job of managing their own expectations. We have become so conditioned in the last 20 years that the Fed will bail us out with stimulus, that we'll have low cost of capital, and we'll be able to just, business will just be able to grow with R&D because the cost of capital is so low, and therefore we get these astronomical returns. And this is what people expect. And then when you start to say, oh, that's gone, that's over, we're not stimulating. In fact, we're not going to buy. In fact, we're going to raise rates. The cost of capital is going to go up. People just don't know what's happening. I mean, everyone is still crying for a Fed pivot, Matt. Can you believe that people are still wanting the Fed to reverse course, cut rates back to next to zero and start stimulating again? They don't have any concept of reality of the economic reality of we can't just create new economic rules just because we're America.
Yeah. So, the Fed is not causing this. The Fed is reacting to this. It's happening whether you like it or not. The Fed is just trying to manage how bad it is.
Exactly. So I just think that people need to just wake up and just prepare that there is something that is to come. And it will be shocking and it will affect everybody. And unfortunately, don't let that cut you off guard. If you've seen this podcast at all, then you should not be cut off guard. You should be like, oh, this is what Rebecca was talking about, because I don't know how else to say it. I have so much data of what's coming, but until it gets out there, I just have to wait like everybody else. Right. It's awful. The waiting game is terrible, I have to say.
Yeah, I hear you. It's as one of my friends would call it, you're waiting for the slap. You're waiting to be slapped. You're not sure when the slap is coming, but you're going to get slapped. They go, well, the only question is when. You're waiting for the slap. All right. Yeah. Rebecca, thank you so much. This has been fun, as always.
Thank you, Matt. I really love doing these with you. I wish I could have you all the time.
I appreciate it.
All right.
So everybody go to walserwealth.com, check that out, and make sure that you get on Rebecca's schedule if you're interested in working with her and the team directly on your finances.